Hey everybody, Doug here with another portfolio update video, long overdue. I think the last one we actually recorded was for July 2023, so this is long overdue. My apologies there, but it gives us a really good opportunity actually to see our investment strategy over the course of a year and 5 months, a year and 6 months, something like that, and actually see how it panned out with consistent contributions to a portfolio that is structured around dividend growth. So this will be maybe a little bit longer than the previous video, but I'll try to keep it relatively short. So first things first, let's state the goal of the portfolio. It is a dividend growth portfolio, which means that we want to invest in companies that have large growth potential. So a lot of these things exist obviously in the technology sector with your Apples, your Microsofts, etc. But we want to have every position also pay us a dividend whenever possible. So with that in mind, let's do a quick update from where we last were to today. And if we look at this timeline here, I can bump this back all the way to the inception of the portfolio in M1 Finance, which goes back into 2022. And we kind of covered this in the previous video where I opened this, this brokerage, and I kind of just let it sit. I didn't really do anything with it, which is a really big missed opportunity. I should have been contributing to it, but we learn from our failures, right? We learn from our mistakes. So at the time of the last video, it was in this July timeframe here, and we obviously made another big contribution. And what this actually was us transferring investments from another brokerage into M1 to consolidate everything. So if we look at kind of this beginning of August timeframe, we're looking at 35,000, somewhere along those lines, dollars invested into the portfolio. And our investment strategy was we were going to contribute $350 every single week into this portfolio. And we've done that, and we will show proof of that as well. So if we're looking at that 35K, give or take hundreds of dollars in between the days, until now, right now we're looking at 73,000 as of December 24th, 73,000 as of today, which is December 26th. So you can see that we've had a pretty big growth, right? Just over double the amount of money invested. And this is both from us contributing money and also our positions appreciating in value. If we take a quick look in our activity tab, we can actually filter this by deposits and withdrawals only. And you can see this entire time in between videos, we have been contributing. This goes to August 2024, but we can back this up. You can just see over on the right-hand side here, these $350 deposits going all the way back. Let's see. We should be looking for June somewhere around here. July. So this was our first contribution since we made that video. $350 from July 28th all the way to today. $350 minimum invested every single week, with a kind of a stretch goal of contributing any extra money at the end of the month, which, to be fully clear, I haven't done a good job of doing. But that $350 is automated. It just happens regardless. So that's the proof behind all of this, right? We've contributed what we said we would contribute, and now we can see where we're at. So if we jump back to the portfolio, if we're looking at this all time frame, you can see that we're up 40%, but I'd like to kind of filter this down more toward that 1 year time span. And we can see that at the beginning of the year, January 2024, we're hovering around this like $46,000 value in the portfolio. And then obviously right now we're looking at that $73,000 value invested. Over the year, we've made 16.5%, which is pretty good. I mean, it's free money, I guess, right? 16.5% for doing relatively nothing. This is probably underperforming when you compare it to something like the S&P 500. But one thing I do want to make clear, and I think I did in the first video, is that I do have another account. I have both a 401k and a traditional IRA which is really centered and focused around those growth opportunities, meaning they're both heavily invested in VTI, which is an ETF that tracks the S&P 500. So this is kind of a side portfolio of mine that, I obviously want to grow this as well as I can as well, but it is more kind of dividend growth focused. So take that for what you will. Normally in these videos, we jump through every sector in our M1 brokerage. And what these are slices of a pie. And if you're unfamiliar, you basically set a target for each sector and then a target for each position inside of that sector. And M1 will automatically purchase anything that is under the percentage, right? So if we look at this, technology, it makes up 25% of our entirety of the portfolio. But inside of that 25%, we can see that Apple, it's targeted for 45%, Microsoft is 30%, IGV is 20%, IBM is 5%, right? So when M1 says, oh, you contributed $350, or there's a dividend payout event, and it reinvests those dividends, it's going to come through here and it's going to say, oh, IBM is actually under your target, so I'm going to invest money there first. Same thing with Microsoft, right? It'll try to get as close to that target percentage as possible. That being said, if we go through these positions, obviously we've done really well in the tech sector. This is a huge growth opportunity, all of these positions. Your Apple, your Microsoft, your IBM, those are all pretty well-known companies. IGV, if you're unfamiliar, is a ETF in the tech sector that tracks software primarily. So think of Salesforce, Oracle, stuff like that. You can look at their list of holdings if you're super curious about it. And actually, IGV is one of the positions that I'm thinking about cutting from the portfolio, which seems weird considering that we've had pretty good growth here. But the problem with IGV is it doesn't pay a dividend, and I'd like all the positions to pay a dividend. So realistically, what I'm planning on doing there, if I do make that move, is taking out IGV and literally just replacing it with Salesforce and potentially Oracle, which are two of its highest held positions inside of the ETF. But each of those pays a dividend, and that's kind of the goal there. So we'll see what happens in 2025. That'll all be covered in a different video. But if we look at the next sector here, which is income funds, you can see that we have SCHD and JPI. SCHD has done really well for us. It's a huge dividend payout ETF, and it also appreciates the underlying capital, which is really good. So no plans to change SCHD realistically. JPI, I'm actually considering about cutting from the portfolio as well. And that's simply due to the way that taxes work with its dividend payouts. And maybe I'll do a video that goes into all the different ways that dividends are paid out in the future. But just know that there's tax implications for JPI that make it maybe not great to hold in an individual brokerage. If this is in an IRA or something like that, it would be different. But just know there's a difference with the way that they pay out dividends, and I'm considering dropping it, even though we've had pretty good growth over the last year in this position as well. If we look at real estate has been hit really hard this month, and that's due to the Fed announcing news about rate cuts, et cetera, et cetera. You can go on Yahoo Finance or any of those finance-focused websites, and you can learn a little bit more about what the Fed is thinking about doing there. But real estate got hit relatively hard. You can see both positions are down in the red. I'm not overly concerned about this because not that long ago, October, September, we were actually up in both of these positions, and they're both monthly dividend payouts, so I want to hold these regardless. I don't foresee any movement in the real estate sector of our portfolio. Financials, fintech has done really well. All of these positions I really like. I might rebalance this to be a little bit more equitable across the positions. So right now, for example, JPM, its target is 40%. Maybe we do something where each of these is set as 20% instead. That way we get a little bit more diversification inside of this sector. Again, I'll cover all of the changes we make in a different video, but for now, just know that all these positions have done really well for us over the last year, with JPM and Main Street and MTB actually kind of leading the charge. If we move on to consumer, similar story. Most of these positions are up in the green, which is really good. The only kind of outlier there is Pepsi. I'm not sure if we need to necessarily hold Pepsi and Coke both. Maybe just one is fine there. But for now, I'm not making any changes. I'm going to go through the entirety of the portfolio and do another video about how I kind of want to approach it for the new year. Spoiler, I want to cut down some of the positions. We have a lot of holdings inside of the portfolio that make it difficult to kind of stay on top of everything. So just know that we're overall definitely in the green, about 15% in this sector specifically. And we can see that it went from 4K all the way to almost 7K at the end of the year. Not quite hitting it, but that's okay. And then moving on to industrials, this is another sector of the portfolio that I'm thinking about making some cuts, specifically around AMCR actually. The primary reason there is even though they're a relatively good dividend payer, I haven't seen a ton of upside on the underlying capital in that position. And I'd really like to focus on companies that will appreciate both in the principal and pay a dividend, even if that dividend is a little bit lower, right? So targeting that potentially lower yield but higher appreciation. But again, covered in a different video. But overall, this sector has done relatively well for us as well. Looking at about 2,500 at the start of the year, and then ending at 4,200, something like that. So pretty happy with that. Healthcare, a similar kind of situation here. I'm thinking about dropping one of these positions. Again, just the overall goal for 2025 is just reduce the amount of holdings inside of the portfolio itself and just make it a little bit more manageable for me in the time invested. So Johnson & Johnson, we're down just shy of 5%. Pfizer literally just squeaking into the green with a 6-cent return there, which isn't great considering that it's over the course of an entire year. But I'll need to do, research, all that stuff and see what we want to do there. Energy, I'm not planning on making any changes. Both of these are good dividend payers. They both have a ton of upside potential. Do we need to hold both of these? Maybe, maybe not. And maybe we end up cutting one just to reduce the holdings and no other reason. But pretty happy with the way that energy has been performing for us, even though it is relatively low. Telecom, surprisingly, actually has had a really good return for us over the last year. With AT&T, getting up toward 50% return on investment there, which is really good. AT&T cut their dividend a long time ago, and unfortunate, but it's the way things go. Both of these have been doing relatively well, and they're actually both still pretty good dividend payers, so I'm not overly concerned about it. And telecom only comprises about 3% of the overall portfolio, so I'm pretty happy with leaving both of those on there, to be honest. But again, I'm going to review the entirety of the portfolio and kind of see what we may or may not want to get rid of. So that's the portfolio, all the positions inside of it, held within all of these different sectors in M1 Finance. And I should note that there will be a link to this portfolio in the description of the video. So if you want to go in and deep dive and take a little bit more time and look at all the different sectors and positions, you're more than welcome to do so. If we move on to holdings, what I like to do in these videos is kind of take a look at what is performing the best and what is performing the worst, right? So if we sort this by unrealized gain, you can see some of our top performers here: Cardinal Health, Walmart, Apple, IBM, Caterpillar, so on and so forth. I'll scroll through this relatively slowly. Hopefully you can take all this in. It's a lot of positions, I know. And then toward the bottom, this is where I kind of want to look and see what is worth holding and what's worth letting go at this point. O and Stag I'm not going to let go of, even though they're both pretty deep in the red right now. I think there's still a ton of upside here. Very solid financials. I'm not overly concerned. And these should bounce back in more favorable markets for real estate specifically. Overall, this is looking at the entire timeline of the portfolio. So you can see that we're down in Pfizer, Verizon, Pepsi, Johnson & Johnson, AMCR, AWR, JPI, and Starbucks as well. So some of these positions may or may not be on the chopping block. Again, we'll cover it all in more detail in a future video here. This is really more about just getting the update out there and showing you what a year plus 5 or so months of consistent investing kind of does in a portfolio, right? If we look at our dividend income for 2024, we can see that we're making $1,829 for the entirety of the year. So all of that money, it automatically goes back into the portfolio, reinvested, and it buys up shares for any positions that are currently underperforming or not hitting that target that we talked about earlier. So it's relatively hands-off, which is just my preferred way of investing at the moment. I just want to have a solid core portfolio of positions, and I just wanted to autopilot. I just wanted to invest in dollar cost average the entire time, whether something is up or down, just sink money into it. And what this actually does is it handles some of that work for you in the sense where it's going to target positions that are underperforming the target allocation. So like we saw earlier, Microsoft and IBM, I believe, were actually not hitting their targets. So when the next, round of money gets injected into the portfolio, it'll target those positions first. So it's always targeting things that are under target, which is really nice. If we compare this to the previous year, we were looking at $986 for 2023. So we've seen a really positive increase here. Just shy of $1,000, right? Probably like $900 of increased dividend payouts over the last year. And that's just due to contributing regularly to the portfolio and then just continuing to reinvest all the dividends. And it tries to give you kind of the sneak peek into the next 12 months. And it's currently looking at December of this year as part of those 12 months. But we're looking at just shy of $3,000. I think one of the goals for 2025 will be to get this over $3,000 in total dividend payouts. I think that's one of the goals that I'd like to set for this portfolio going into the new year. If we look quickly at funding, you can also see, for that last half of 2023, we invested $9,050 into the portfolio. And then 2024, I believe there might be one more payout or one more deposit coming. So we're looking at, just over $18,000 invested into the portfolio over the last year, which is really nice. Obviously that's a pretty sizable amount of money, but the point is you can take any amount of contribution and kind of replicate these results, right? It might take a little bit longer, but if you can't invest $350 a week, maybe you're doing $350 a month, right? So this is just more proof in the pudding of, sticking with the initial investment strategy and seeing, kind of where it takes us here. But if we look at activity, we can look at dividends only. And for, the month of December, we can go through this list. I won't list out every single one of these, but, obviously SCHD, it's the dividend king when it comes to ETFs. And this December, it paid us just under $100. So hopefully by the next time we get an SCHD payout, we will hit that $100 mark, but we'll see. But we can see that, we have a lot of positions in here that actually pay us a pretty sizable amount of money, considering that we're doing essentially nothing to get it, right? So like I said before, Stag is one of the monthly payers. So it's currently at $16.70 each month. and then O coming in at 1844 every single month. Those are just landing and getting reinvested into the portfolio there, which is the whole point, right? So the dividend snowball. So that's going to do it for me for this update video. Hopefully we kept it relatively short. It looks like just under 20 minutes, but hopefully this was helpful. And hopefully, it gives you some ideas for what you can do with your own investment portfolios, etc. This isn't financial advice, blah, 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 right? All those things. But like I said, there will be a link to this portfolio in the description. Feel free to take a look. I think there's like a referral code in there as well. So if you want to try out M1, feel free to use my referral link. That would help as well. That's going to do it for me. Hopefully you enjoyed. Hopefully this was informative. The goal going into 2025 is to do one of these kinds of update videos probably once a month, and then supplement that with additional content. So for example, a video describing the different ways that companies pay out dividends, right? And what tax implications there are for those different ways. One video that I'm working on currently is what we want to do in 2025 as far as portfolio changes and investment strategy changes, right? So that's kind of the plan going into 2025. Hopefully you follow along for the ride and we can learn from my mistakes together. Hopefully you won't have to repeat them. So anyways, that's going to do it for me. Thanks again for watching, and we'll see you next time. Bye-bye.